Let's welcome in Samir Arora. He's joining us. He's a market master today, founder and fund manager at Helios Capital. Samir, it's good to see you. Thank you very much for being on the program. So I have two questions, and you are someone who's invested and watched not just India, but regional markets very closely as well, China as well. So let me start with that. Is this time different? That old question. It rarely is, but let me frame it that way for China. And second, I mean, is this a real thing? And second, flows. We saw some very large selling figures in India over the last 2 days, foreign selling. Is that on account of China as well? Go on.
So second part, not so clear, but first part is it can go on, I think. By the way, in our fund, we used to own Alibaba and C-Trip, and we bought more Alibaba even yesterday because I think it can go on for some time. And actually, I don't think it's a bad thing if China market does well for us, as in mostly for India funds. But before that, so the China thing, first of all, the government has to take a call now whether they are going to make sure that they are able to revive confidence, revive this thing, or they make it as a given. They have the money, they have a lot of advancement in technology. They have to basically revive sentiment of the consumer. There was maybe some pressure even for people who are rich to not openly spend because of this shared prosperity and things like that. So if they let it go, like for India, for many years, we were able to say that although there is a big divide between the rich and poor, but at least the rich are doing premium and the care recovery and all that. So you don't believe that there are many super rich people and middle class and upper middle class, which all they need is the market. A market means the government and whatever to let them be as they are rather than always show that they are, part of a shared system. So it can go on, I think. And maybe some pockets do it only, but it can go on because their market was really cheap. It was just that it needed a trigger. But I think it is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China. The other thing is if the Chinese market does well, and if the US market does well, the Indian fund managers, the mutual fund guys, they will have less reason to sit on cash. Our premium to emerging markets, our premium to China has shrunk because the Chinese market is up some 25, 27%. So we are some 5-6% cheaper than we were. Just to finish one more line. So meaning the market used to say that Indian market trades historically at some 40-50% premium to emerging markets. And in recent periods, it has become 165-170%. So that does not mean it was 20% overvalued. That means it was 170 divided by 150. Correct? Because 150 is equivalent. So it was 10-12%. Let us say, if that was one issue, that it was 10-12% more than the longer term average. Now that it would be, according to me, 5-6% more than longer term average, just with China moving up 25%, because that would have shifted the valuation by 5-6% at an index level for emerging markets. So I think you don't want China to blow up and feel happy on that. If they're doing well, it's okay. We may underperform, but we will not be in absolute negative.
But Samir, listening into you, but the thing is, when $3 billion leave the market in 3 days, it does catch people by surprise, right? I mean, we were sitting on a high horse saying we don't need the foreigners and that's fine, and we have local money. But exactly, I mean, we've forgotten what FII selling really feels like, and we got a nasty reminder since the start of October. How long can that continue?
But that's what I'm saying. I don't know whether it's related to China only, because there are three issues going on simultaneously. One is China, let's say, one issue. Second is that if people had some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that is it hedge funds who are selling? Is it long? Because my big picture thing without overly knowing this is that nobody does it like that. No regular long-term or even medium-term investor sells a market which is, at least in the last 3 weeks, zero, to buy a market which is up by the time he ends up buying it 30% higher. And mostly the stocks that he will like to buy are 40% higher. Mostly you do it a little bit more gradually. This kind of thing normally is a burst in the beginning, and that can be easily countered after some time.
Samir, at least in the last couple of years, we haven't seen a fall greater than 5%. So now investors are saying that is this the time to buy stocks or buy any themes that they like? So, if you have to find opportunity now in this little bit of a correction, what would you recommend?
So first thing is that 5% correction can happen without a reason. If this 5% correction has happened for reasons like Israel attack or Iran sending missiles to Israel, or it is because of Hamas and whatever, and it is because of China having done this, then it's a pretty decent market that with only 4-5% fall, it has absorbed all this. So I think the market continues to be strong because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confuse the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much. But the general big picture thumb rule would be any stock that you own, which is down 5, 7, 8% without any reason, you buy 0.5% more of that. For us, these stocks remain primarily right now in the financial sector because the IT sector, we have just bought, now we have some 13, 14% in IT, but we need to wait for their results and guidance and language and how they say, because we have all taken it for granted that the worst is over and that there'll be some improvement from here. But let us again hear it from them. And in consumer, I genuinely think that there is a slowdown and that there is too much competition, and we come up with a new excuse every month. Sometimes it is big rain, then big summer, then politics, then cold, because now they're saying it's very cold. So then they suddenly say, oh, let's buy some cream guy because somebody's skin became dry, so they want to buy those shares. So I don't like that. I like very, sort of somewhat reasonable prediction of growth, or sometimes very high growth, like these food delivery companies and all that.